50%, 50% of the American
50.
public says they cannot come up with $1,000 in an emergency. So if you stimulate the economy and the top 50% of income is getting cheaper loans and businesses are expanding and they're taking up more raw materials and prices are going up, the bottom 50% are not sitting there owning homes and have stock portfolios that could go up to offset that. They just watch their fixed salary buy them less and less and less.
Welcome to Year in Business. I'm thrilled to say that we're joined by Jim Bianco. He's the president of Bianco Research, based out of Chicago since 1990. Jim's commentaries have offered a unique perspective on the global economy and financial markets. Jim, great to have you on the show.
Happy to be here.
Let's start off with the latest news around the One Big Beautiful Bill, which got passed by the Senate. A multi-trillion-dollar tax and spending package. It's been a top priority for the Trump administration. Can I get your reaction?
Yeah, it did pass the Senate barely by having the vice president break the tie because the Senate voted 50-50 for it. It is different from the House bill, so it has to go back to the House, and it now needs to get approval from the House. If the House changes it, then they keep going back and forth until they both agree on exactly the same language. As far as the bill goes, it looks like we're going to get a version of it. We know most of what it's going to be because they'll tweak it around the edges. I'm a little bit disappointed by the bill because I don't think it addresses a big need, in that if we did nothing, we would have a tax increase because the current tax rates in the United States would expire and then we would go back to higher taxes. So it just extends the current level of taxes. So that's great that the bill does that. As far as spending cuts, getting the deficit under control, getting the debt under control, it's a bit disappointing on that side of the bill. I wish it would have done more. I guess all things being equal, I guess they'd rather take the bill than not take the bill, but I'm not exactly thrilled about it in its current form.
I mean, that leads to my follow-up question here, because stocks are at an all-time high. I mean, the S&P 500, they're holding above 6,100 points. But you've made the point repeatedly that your impression is that we are in a crisis. Why is that?
I'm not sure that I've said that we're in a crisis. I've made a lot of impressions in the market. What I have been saying is that I don't think interest rates are going to come down as if we're in a crisis. I think that, the biggest mistake that President Trump has been making with interest rates, and a lot of other people make with interest rates, is they think down is good, lower interest rates are always better, and up is worse. Well, that applies kind of for the stock market, but it doesn't necessarily apply for interest rates. Sometimes rates go down for bad reasons. The economy's weakening and it needs extra stimulus. Sometimes they go up for good reasons. The economy's strengthening and the cost of money should approximate what the returns are in the economy. So without that kind of crisis, what I do worry about is that if he cuts interest rates and he says this is because the economy is doing well, it's just going to overstimulate the economy, create inflation, and could participate into making that crisis that everybody's afraid of. So I would prefer interest rates to kind of stay where they are. And I would argue, as you mentioned, the stock market's at all-time high, economy's doing well, inflation is a little sticky, and I still think there's a bit of a problem there, but nothing like it was 3 years ago. So why do we need interest rates to go down? What is it holding back in this economy? It's not really holding back anything.
Yeah, we'll break out the interest rate conversation in a lot more detail shortly. But I think I needed to be clear in terms of what I meant by crisis. I mean, let's talk, maybe the way to describe it is an inflection point. The global reset, the realignment of the trading system. I was catching up with Bob Diamond earlier, and he made it clear that as much as the end goal from this U.S. administration is rational self-interest, the process of getting there combines controversy and a lot of noise. And I'm paraphrasing here, but do you see method in the madness of this White House?
Yes. Oh, absolutely. If you frame it that way, I definitely do. I've argued from a big picture standpoint that every time an economy like the United States has either a recession or a financial crisis, and it had both in 2020, it changes. And I've often warned, change does not mean it's worse. I mean, when you say the economy changes, everybody thinks it's worse. It's not necessarily worse. It was an apple and now it's an orange. It's different. And the biggest example I've been giving about how it's different is the whole thing about remote work. We are seeing a evolution of the economy that there was the pre-COVID economy and now we're in the post-COVID economy. And so, yes, that is very different and that needs to be understood. And as part of that, I've argued that's going to be higher inflation, not 8, 10 or Zimbabwe levels of inflation, but the U.S. economy used to run under 2% inflation. I think it runs more like 3 or 4% inflation, a completely different labor market, and with tariffs, a reordering of the global trading system. I've heard a great term recently that we're moving from globalization to segmentation. And we need to understand that the era of anything goes, search the world for the lowest, cheapest place to produce your product, go there, to a segmented type of economy right now. So yeah, it's going to be a very different post-COVID economy than it was, say, in 2019.
I mean, the latest lines coming out suggest that the Trump administration has reached a form of an agreement with Vietnam on the tariff side of things. To flesh out the conversation around the Fed, right? One of the most powerful institutions in the world, depending on who you ask, it's the most powerful institution in the world. But there's no doubt that its credibility has been jeopardized in the last 6 to 9 months. How much of that credibility, of that prestige, do you think it has lost?
Oh, I think it has lost some. I mean, you could even back up. And if you go back to 2021, 2022,
yes,
when Jay Powell was famously saying inflation would be transitory when it was on its way to 9%, and then had to hurry up and catch up with rate hikes, I think then that they further damaged their credibility last year. There was signs last year that the labor market might have been weakening. They cut interest rates by 50 basis points. That would be a double-sized cut to start in September of 2024. Followed up in November and December, and almost the moment that they cut interest rates, the labor market stabilized. And President Trump was not wrong to say historically the Fed would sit out between the beginning of September and Election Day in an election year. They just wouldn't do anything. But this Fed decided to get not only cut rates, but cut by a double shot. And he was accusing them of being partisan by saying that they were trying to stimulate the economy to get Vice President Harris elected. And so maybe that wasn't their objective, but the optics of it did not look good. And it really hurt them. It really hurt them from those perspectives. Now we've got a situation where the president almost daily, or somebody from his administration almost daily, is attacking the Federal Reserve, demanding that they lower interest rates. And it's put Jay Powell in a no-win situation because one of two things is going to happen in the next few months, or 3 things actually. The first one is the economy slows. If it slows, I don't think it would, but if it does, it's Jay Powell's fault for not cutting interest rates earlier. Second is the consensus on Wall Street is there will be rate cuts later this year. If he cuts rates later this year, the comment would be, why didn't you do it in March or in May? Why did you wait? So you're still at fault for being too late, as President Trump likes to call him. The only option that works for him is if inflation runs hot and justifies no move. And then in that case, the Fed is in trouble because your primary job is to hold prices down, and they're not going down. So there's really no scenario where they wind up winning in this thing.
Yeah.
So yeah, when you're done, when we're all said and done, in May of 26, when Jay Powell's term ends and we get a new Federal Reserve chairman, their prestige will have definitely taken some hits. And there's no way around it.
Jim, you've crafted a chart which shows the cumulative attacks on the Fed chair. And what I loved about that chart is it showed that it's working in terms of convincing the market of a certain trajectory, right? I mean, the probability of a rate cut slumped to 8%. In terms of what that means for the possibility of a replacement of the Fed chair, how do you think that is going to be executed? And pulled off?
Well, there's a term that they've been using is what's called the shadow Fed. And now remember that some mechanics here. The Federal Reserve Chairman is a governor. There's 7 governors, and then one of them gets appointed as the Federal Reserve Chairman. There's a governor spot that will open up. One of the governor spots expires, Andrea Kugler is her name, at the end of January. And it's been floated on the idea that the Trump administration would appoint the new Federal Reserve Chairman somewhere by September, 8 months or so before the term is over. That person would then approach the status of Jay Powell because he's the incoming chairman versus the current chairman. And then they would appoint him in January, and I'm using him because most likely it's going to be a him. They're going to appoint him in January to be on the board as a governor, and then we'll be in an unusual situation where we'll have 2 Fed chairmen at the same time. The current one who ends in May, and then the one that will succeed him in May. And the joke that somebody told me was, in history, if you go back to the 15th century in Europe, they had 2 popes too at the same time, and it didn't work out that well. And that's the risk that you have when you have two competing voices in the room at the same time saying different things. Because obviously, President Trump has made it clear, I am going to appoint somebody who's going to cut rates. He didn't even say if it's going to be justified because of economics. And he said, if they're not interested in cutting rates, I am not interested in appointing them. So we're going to get a very, very different scenario. Unless the economy weakens so much between now and the end of January that the new Fed chairman and Jay Powell are on the same page. But then again, Jay Powell loses because, the economy is weakening and he held rates too high for too long, according to President Trump.
So who is the most likely person to take on the new position? I mean, there's speculation that Kevin Warsh could be leading sort of the race. Is there anybody else you see? I mean, Scott Bessent keeps getting asked the question. I'm starting to wonder maybe, we need to start considering him more, even though he doesn't flatly deny it, but it's always a vague answer from him. But anyway, I want to know what Jim Bianco thinks about it.
Yeah, so there's about 4 or 5 names that have been thrown out there. The leader is Kevin Warsh. He was a Federal Reserve governor about 10 years ago, and now he's been, doing think tank kind of stuff, talking about the Fed. By the way, he is a family friend of President Trump. President Trump has known him for over 30 years, so he's got that going for him as well. Another name that has been thrown out there, other than Scott Bessent, the Treasury Secretary, and the joke is, could he do both jobs at the same time, be both the Treasury Secretary and Federal Reserve Chairman? But other names are Kevin Hassett, Harvard-trained economist who is the National Economic Council advisor head as well. He's written several books about the economy and markets, so he's well qualified for the job. Chris Waller is a current Federal Reserve governor. His name has been thrown out. And the reason his name has been thrown out is Chris Waller was notoriously one of the more hawkish members of the Fed. And about a year ago, he switched, and now he is not only the most dovish member of the Fed, he is far and away the most dovish member of the Fed. And the question has been posed, is he pandering to President Trump to get the job? And earlier this week, the week we're recording, Scott Bessent said that among the people being considered, there are current Federal Reserve members being considered, and that would obviously be Chris Waller. David Malpass is on the list as well, too, the former head of the World Bank. But I think that if I was to rank them in order, I would probably rank them as Kevin Warsh being in the lead, Scott Bessent and Chris Waller kind of as tied for a second, but nobody clearly in the lead. No one with a better than 50% chance of getting the job, at least at this moment.
Okay, that's very helpful to know. So no clear decision has crystallized just yet. The CEO of Mainstay Capital Management, I'm going to read out to you what he posted on X. He said, the markets know that Trump will indeed appoint the most uber-dovish Fed chair he can find, who will carry out his desire for a far lower Fed funds rate. Lower interest rates mean a lower dollar compared to the euro, or at least that has been the historical reaction function. The bond vigilantes may have something to say and do about the longer end of the curve if the next Fed chair cuts too far or too fast? Agree or disagree?
Well, 100% agree with that. And you saw that last year. In September 18th of last year, the Fed cut the funds rate by 50 basis points, as I mentioned before. The 10-year yield in the United States was 3.6%. The Fed followed up with a cut in November and December and cut a total of 100 basis points. Over that same period, that 3.6% 10-year note went to 4.8. It went straight up. Yields went straight up as the Fed was going down. If you go back the last 60 years, that is one of the biggest rises in yields while the Fed was cutting rates. The only other one that was larger was when the Fed started cutting rates in 1981. But of course, we also started with a 13% interest rate, went to 15% during that period. So you could argue this one had bigger impact by going from 3.6 to 4.8. What does that mean? It means that the market was rejecting Fed policy. In other words, when you cut interest rates and you make money cheaper, you're offering stimulation. Companies could borrow cheaper. People could take out loans at less monthly payments. So you're trying to encourage more economic activity. And when the yields go up, the market is saying, we don't need that. All it's going to do is produce more inflation. People are going to bid for stuff, push prices up faster than they think. And keep in mind, in the United States, the unfortunate reality is, according to the Federal Reserve Consumer Finances and Bankrate.com, 50% of the American public says they cannot come up with $1,000 in an emergency. They'd have to borrow it or put it on a credit card or get it from a family friend or something like that. So if you stimulate the economy and the top 50% of income is getting cheaper loans and businesses are expanding and they're taking up more raw materials and prices are going up, the bottom 50% are not sitting there owning homes and have stock portfolios that could go up to offset that. They just watch their fixed salary not buy them less and less and less. And that's why inflation can be so terrible in that environment. And that's why the bond market, I think, was rejecting what we saw last year when the Fed cut rates. And the risk is if they cut rates again, and the market thinks the same, it's not necessary. It's just going to produce too much stimulation and more inflation. You'll produce higher interest rates at the long end of the yield curve, not lower. If the market agrees we need more stimulation, the economy's slowing, there is no risk of inflation, then long-term interest rates would fall.
You've been through quite a few turbulent geopolitical periods since you started in finance. Markets lately have been remarkably resilient, Jim, right? And the latest war between Israel and Iran was one example. How much of a wake-up call do you think that was, that resilience?
I think it's a big wake-up call. Not only Iran, Israel, Gaza, Pakistan, India. You could go through a lot of these scenarios, and the market seems to kind of shrug them off. Now, what I do think has happened in the market, and talk about kind of the dynamics of what's going on in the United States, is we currently have more ETFs listed on the New York Stock Exchange than we have stocks. So what's happened is the public is now realizing DIY, do it yourself. I could do it myself. And we've seen tremendous increases in the public not giving their money to professional managers, but investing it themselves through the use of ETFs or giving it to a wealth manager who turns around and buys ETFs on their behalf. So you've got millions of people now that are investing in the market with a little bit of money. They're the dominant force in the US as opposed to fewer institutions with lots of money. Those people that are playing in the market, and by the way, they get their feedback from social media and the like, they're momentum players. Buy the dip. The market always goes up. FOMO, fear of missing out. These are the types of battle cries they take. So whenever something harrowing happens, like Iran and Israel get into a war, is it World War III, or Trump announces tariffs and the market dives in April, the reflex of this dominant player is get in. Well, it's a terrible story. What if this or that? Get in. It always goes back up.
That's
you pointed
worrying,
out,
though, because the point you're making is that the market's not necessarily getting better at pricing these geopolitical risks, correct? Wherever it is in the world, these frictions in Europe, Asia, or the Middle East, but it's this democratization of global finance, and specifically, some of these ETFs you mentioned. I can speak for, the rest of the world, where I've seen the opening up and this tsunami of liquidity that's coming from the sidelines. So in many ways, that is offsetting, right? It's creating a buffer to the extent that the feedback mechanism is a little bit damaged, right?
absolutely. It absolutely is. And, it's easy. I was going to say the stock market, as we're recording, is at another all-time high. I could say, you could say the feedback mechanism is broken. This is going to we're going to pay a price for this down the road. True. But we've been through COVID. We've been through 9% inflation. We've been through rate hikes. We've been through multiple wars. And yet every time the market keeps bouncing back and bouncing back and bouncing back. And the problem is this FOMO argument, fear of missing out. Someday it might blow up. But I would, the S&P's at 6,000. You might be right, Jim. It'll blow up from 20,000 to 15,000. But I want to be in it all the way to 20,000, and then I'll deal with it. But others say, no, it might blow up from 6,000 to 4,000 right now. So yes, we could say that. And yes, it can be true. We don't know when. But that argument is going to fall on deaf ears. No one is going to shy away from the market because this overwhelming belief, it always goes up. Buy the dip, fear of missing out. That is the democratization. And what they'll justify it by saying is, I'm using certain strategies. I'm buying equal weighted S&P. I'm buying small cap stocks. I'm buying international stocks. They can do that now because of the ETF. 20 years ago, the only way you could have done that is give your money to a professional investor who does it on your behalf. Now you could do it yourself.
For our global audience watching now, a quick reminder to not miss the ultimate investing tips. Jim Bianco is going to share those a little bit later. Actionable advice. I want to get back briefly to the Fed, Jim, and talk about the supplementary leverage ratio, right? This is really important. It's a bit technical, but we have to talk about it. And basically, this is about the bank's ability to deploy leverage, right? And that ratio in the past, or the SLR as an instrument, has been really important in preventing larger shocks. Can you explain to our viewers today why that is?
Yeah, so this was invented coming out of the global financial crisis in 2008. That a bank as a fractional reserve system is always levered, right? They take their equity and they have many times the number of assets over the equity that they have. And the Federal Reserve, the FDIC, the Federal Deposit Insurance Corporation, and the rest try to use rules to rein in the banks from getting too leveraged and too exposed to a financial crisis requiring a bailout. So the Fed has this supplementary leverage ratio where it says if you buy a treasury security, a long-term treasury security, you have to set aside some of your capital in order to for this ratio, to satisfy this ratio need. So you effectively delevers you a little bit and it makes it a little bit more unattractive to own long-term treasuries. Well, what they've done now is they're going to suspend that rule. So if you buy treasuries, you no longer have to put capital against it. You could lever up in treasuries. Now, I don't think that's going to lead to a massive buying spree of treasuries now, because most banks that have owned treasuries are underwater because yields have gone up for the last couple of years. They've gone down for the last month or two, but over the last several years, they've gone up. So they're sitting with a net unrealized loss on their positions. They saw what happened to Silicon Valley Bank 2 years ago because it was, despite the SLR, leveraging treasuries and it blew up. Where it will help is in the next downturn when everybody piles into treasuries and everybody starts to buy treasury securities in a period of crisis, the banks will be incentivized to do the same and hopefully add liquidity.
So the Fed voted 5-2 to reform this enhanced supplementary leverage ratio. Goldman Sachs was of the view that this kind of reform could free up the balance sheet of U.S. global banks by as much as $5.5 trillion. But you're saying that's not something that's going to happen in the short term. This would be a very long-term kind of impact, right?
Yeah, yes. And if it does free up their balance sheet, it's not necessarily going to lead to more treasury security purchases. They might hand out more loans, or they might buy some other type of assets as well. They might actually, so they could do other things with it. But I don't think necessarily the supplementary leverage ratio rescission is going to lead to an immediate burst of treasury security buying. It can in a crisis. It might lead to more lending. We don't know what it's going to do, but we do know that they are rescinding it, and the banks are going to have more room now to be a little bit more flexible with how they want to work.
And then there's all this talk about it being part of the Pennsylvania plan, a new era of financial repression. What makes this new era to anybody today looking to allocate money? What makes this new world different from the way we understood investing prior?
I think that we need to understand that in the post-COVID world, we've got a completely different set of circumstances that we're dealing with right now. More inflation. We're dealing with the loss of synchronized global central banks. That used to be a big term we used to use, but not so much anymore. Look, the European Central Bank and the Bank of England, they've been cutting rates regularly, and the Fed has been holding steady for a long time. So we've been seeing them kind of all go off into their own different directions. The Bank of Japan is actually hiking interest rates. So we're going in different directions as well. So we need to understand that the rules that we used to understand how things worked are not necessarily the way that they're working now. And some of those rules are in flux right now. We're still trying to figure out what some of those new rules are, as we pointed out with trying to reorient the global trading system through the use of tariffs.
To everybody watching, we'd love to hear from you. Drop a comment below. Also take a moment to hit that like button and tell you too that this content is worth recommending. We would really, really appreciate it. I want to look at some of the best performing stocks, Jim, so far this year, since we're right at the half, obviously we're past the half year mark. Palantir, 82%, Seagate, 66%, Uber, 52%, Netflix, 50%. And then on the downside, Lululemon with 38%, Target down 25%. Which of these do you hold? Any surprises?
And the narrow list of stocks that you mentioned, I don't hold any of them. The biggest surprise to me, and I'll be a little bit different, might be Palantir. I would argue that it's a bit of an opaque company. It's hard to really understand what they're...
Just a little bit?
Yes, exactly. You're buying it on hope. You're buying it on that there's smart people there. Lonsdale and the rest are smart people there working behind the scenes, have government contracts, military contracts. We don't understand them, but they will make them a lot of money at the end of the day. So it's a hope kind of trade. I mean, it's performed well, and it has produced some some profits, and it's hard to really understand. But broader issue with what you've mentioned is we're back to new company technology, disruptive type of companies. Even Netflix is still a disruptive company. Interestingly, in the US, just in the last couple of days, they pointed out that in June, for the first time ever, streaming has now gotten more hours of viewership in the United States than traditional terrestrial or cable TV, satellite antenna or cable TV. So streaming is now the dominant force. And of course, Netflix was one of the big disruptors in that early on. So all of these new technology disruptor companies are still at the top of the list. What's at the bottom of the list is more traditional kind of companies. You mentioned Target, Lululemon, retailers and the like are at the bottom of the list. And actually, if you look at at the very bottom of the list, like the Russell 2000, still is not up on the year, even though the S&P is up 6% on the year. So that bifurcation of, we want, companies that are in the disruptive new technology space, that's what we're trying to push all of our money and all of our excitement to. But if you're a General Motors or a Procter & Gamble, Lululemon, or a Target, good luck trying to get anybody excited about what you're doing.
I mean, the caveat here is that when you look at the performance of the S&P 500 in euro terms, you're actually down 11% so far this year. The FX effect in total returns is a real thing that most people probably don't appreciate.
Yeah, I don't think they do because, we are the reserve currency, right? It's our currency. Your problem is the old famous line. And that Americans think everything is priced in dollars because everything is priced in dollars, right? When they look at the price of crude oil, it's in dollars. When they look at the price of gold, it's in dollars. And so they don't consider exchange rates. You're right. And with the dollar finishing the first half of the year at its weakest 6 months to start a year since 1973, it is going to be terrible for foreign investors. And that is not been a problem because of what we talked about before. You've still got millions of, retail investors in the United States screaming FOMO and plowing into a lot of these companies as well. But over time, unless the dollar does at least stabilize, that is going to become a problem. Now, what would cause the dollar to stabilize? You mentioned it earlier. We get stable to higher interest rates, give investors that would buy the dollar, an interest rate to do it. But we've got a president who's screaming that he wants a 1% funds rate. It's not a lower funds rate. And we've got a president who's saying, I'm going to put somebody in charge of the Federal Reserve whose only mission is going to be to cut the funds rate to 1%, regardless of what is the current economic situation. And so are we surprised the dollar is falling? You're not offering enough interest for the risk, and you're promising that there will be less of it in the future.
I mean, for those, Jim, who are looking to deploy some of their cash, whatever that amount is, what should portfolios look like today? You've been speaking about the 4-5-6 playbook. How does that work in practice?
Yeah, so the 4-5-6 playbook is over the next several years, given the traditional metrics of the market. And I think in the last several years, they do play out. I mentioned that I think that we've got sticky inflation. I mentioned that I think that interest rates are not at a punishing level. They're pretty close to fair value. So 4 is, I think that cash, 3-month treasury bills, money market rates in the US are going to return 4% over the next several years. And that's where they are now, and that's where they'll probably continue to be. Some years they'll be a little bit lower, other years they'll be a little bit higher, but average 4. Bond yields. I think that if you look at what is the fair value of bond yields given the growth of the economy, the stickier inflation that we have, the heavy supply that we've got, 5%. I think that a bond fund will return you somewhere around 5%. So that's the 4 and the 5. Stocks. If you look at the valuation in stocks, and I think, and I'm using like the Shiller CAPE, the cyclically adjusted PE ratio, and other measures like that. They don't work over the next, what does that tell you about what the market's going to do over the next 1 or 2 years? But if you look at it over the next 10 years, it actually does work fairly well. And given the high valuations of the market currently, the Shiller PE ratio is somewhere around 36 or 37, which is very high. Only 2021 and 1929 have been higher than it is right now. That doesn't mean the market's going to crash, but what it does mean is that the bottom line, if you're going to buy stocks now and hold them for 10 years, unless you think there's going to be a revolution in earnings, and by the way, that doesn't mean that Palantir and Tesla are going to make a lot of money. It means GM and Procter & Gamble and Target and Lululemon also have to make a ton of money too. Yeah. Unless that happens, and I don't think that's likely, you're probably going to see stocks return about 1% more than bonds. That's 6. That's the 4-5-6 market. And you're starting to see that, I think, already start to play out in the market. There's been a huge inflow into money market funds. Everybody scratches their head and goes, why is all this money going into money market funds? Because it's yielding 4%.
Exactly,
and they're looking at they're looking at the stock market and they're saying, what's the stock market going to do? Maybe it does return 6, or maybe I'm wrong, it returns 8. You're going to give me half the stock market's return with a $1 NAV because the money market fund is the same price every single. So no price risk. I get half the stock market. For a lot of people in a lot of risk categories that are not very risk averse, that's a great deal. 5% in bonds, that's a great deal too. So that's
okay.
Where the
Let's
4,
talk
5,
about
6
bonds. What about the Bianco Research Fixed Income Total Return Index? Right. So that's one of your specialties. You use all kinds of macroeconomic inputs. What's the distinguishing factor there?
So first of all, the point, we manage an actively managed index called the Bianco Research Total Return Index. There is an ETF that tracks it. Our partners with Wisdom Tree run it. Wisdom Tree, so it's WTBN. The basis for this is when it comes to investing, most people say you don't want to give your money to a professional investor because they can't beat the index. True in stocks, not so true in bonds. Lots of professional investors that understand the bond market can outperform a basic index. So the premise of what we're trying to say is professional investing in bonds can do better than just buying an index, even on an after fee basis. Why? One really quick point. In stocks, your biggest weightings, your Mag 7 stocks, are your all-stars. If you don't have all those companies and have them, they're 35% of the S&P. If you don't have at least 35% of your money in those companies over the last several years, you can't outperform. Most managers pass the CFA. The CFA tell them, these are overvalued stocks, warning, danger, danger, don't own them, and they've underperformed. In bonds, your biggest weightings are your problem children, your companies that borrow too much, your overleveraged companies, your countries that have too much debt, like Japan and the like. And professional managers can say, or bad structures in mortgage products and structured securities. And professional managers can say, problem, red flag, avoid in their big weightings, and you outperform the index. So our investment case has been active management seems to be better in bonds, and that's what we've been trying to push. Now, within that, I've been arguing that as bonds go, people say, man, they've been terrible investments. Yes, because in 2020, we were at 0 on the funds rate. We had to get to 5% by 2023. That produced horrible returns and huge losses for investors. Okay. As my friend Jim Grant likes,
everybody lost some money with that big move in anything remotely related to bonds or anything that prices off of bonds.
Absolutely. But now that move is behind us. And as my friend Jim Grant, the Grant's Interest Rate Observer, says, it's nice to have an interest rate to observe again. And it's 5% or thereabouts. So if you go into a bond fund, you've now got less risk. They're not as sensitive to interest rates. You've got a 5% coupon, and you could start to work off of that. And that's what bond investors, professional bond investors try to do and say, okay, we could see investors, looking at these 5% coupons. I'm talking about investment grade now. You could get fancy with, emerging market debt, high yield, and a lot of other stuff to augment that. But let's just stick with investment grade for this explanation. You start off by saying bonds can churn you out 5%. And if a professional investor can avoid those pitfalls and take advantage of opportunities, they could do a little bit better. Over the last year, we've returned about 6.6%. So we've more than covered fees and offered investors a better option. If we continue to do that kind of thing over the next several years, bonds can, do better than the 5 and the 4, 5, 6 if you use a professional manager.
Okay, I take your point. In terms of alternatives, the Genius Act was passed, and basically it's a comprehensive federal framework that regulates these stable coins. I'm wondering, though, the whole point of crypto was to get away from government. This looks like it's bringing crypto back into the fold of government, right?
You are singing my tune here when it comes to it. See, I've been involved in the crypto market since 2016, 2017, and I've seen several cycles in the crypto market. And the premise of the crypto market was supposed to be an alternative to the current market. And the Genius Act is swallowing it up into the current market. And they make a bunch of claims in the Genius. Look, I'm not against the Genius Act. I just don't understand how they say stable coins are $200 billion and they're going to go to $2 trillion in 5 or 8 years. 90% of stable coin usage is to trade crypto. In other words, if you want to buy Bitcoin, there's no dollars on the Bitcoin blockchain. So we've made a token, a stable coin that emulates a dollar. So then you can, you have to own these stable coins to buy Bitcoin, or if you sell Bitcoin, you get these stable coins and then you can convert them to dollars, but they're the intermediate step. That's 90% of their usage. So if you're said to say to me that stable coins are going to go from $200 billion to $2 trillion, which is an argument you hear, 10x its size, well, you're also saying if 90% of the usage is to buy crypto, Bitcoin's going to go from 100,000 to 1 million. just tell me that Bitcoin's going to go to 1 million in 7 years and forget the stablecoin argument. But one of the things that's gotten people excited over stablecoins, like I was big into stablecoins around 2021 or so, because they were promising some of these new fangled stablecoins. Some of them like Terra Luna blew up. I actually lost some money in it, but they were offering 20% yields, 30% yields. The Genius Act is saying stablecoins cannot offer any yield. So why would I take my money out of that 4% money market fund and put it into a stablecoin that's yielding me nothing? 4% on $200,000, $8,000 a year. Why would I shift into a stablecoin that's going to yield me nothing? Now, if they're going to offer something else in terms of anonymity, or or ease of use that I can't do otherwise, then they might be able to have some kind of a better appeal. But there's going to be no anonymity because the government's going to be involved in it. They're going to be able to see what I'm doing with it.
Is there anything attractive then in the cryptocurrency space, or are you sitting it out at the moment and letting the new regulation and the new lay of the land kind of take hold? Is there anything? Is it Bitcoin, Ethereum, or is it maybe an altcoin?
Yeah, no, I think that there is some stuff that is happening in the space. At the end of the day, I came to it from the promise of DeFi, decentralized finance. The thing about decentralized finance is it allows people to hold, buy, sell, trade, loan against, get a loan against all your coins with anonymity and with security. And in a lot of the world, as an American, I've always said, we're the apex predator when it comes to the financial system. We don't need it. But if you go through Latin America and you go through Africa, in the Middle East, and you look at some of the shaky currencies that the countries issue, or their unsure banks, or some of the bank regulations or lack of regulations, and everybody, even in lesser developed countries, 80% of the population has a mobile phone. Everybody has access to having an electronic wallet and can own something. Government can't take away from you. It can't be devalued by the finance minister of your country, and you could seamlessly use it and transfer it to somebody else. You can lend against it. You can borrow it. You could trade on it. I was all in on that. But what seems to have happened with crypto is it's now become a casino, and everybody's now saying we got to own Bitcoin. Why? Because it's going to go up. Well, what problem is Bitcoin fixing? Store of value. Well, do we need a store of value? Well, the US dollar is going to go down and it's going to lose a ton of money. Well, that's a bigger problem than I'm more worried about what that means for the economy and for investments than owning store of value. But decentralized finance, this was the big battle cry of 2021, and I'm still on it. And where the decentralized finance is taking most of its place or going is in the Ethereum blockchain. Now, the Ethereum blockchain has struggled recently, or Ethereum token has struggled recently, but it seems to be bouncing back a little bit more. But I think that's ultimately what we're trying to do, is present an alternative. Do you need it at the Greenwich Country?
Go with Ethereum rather than Bitcoin because...
Yeah. I was going to say, do you need it in the United States? No, you don't need it in the United States. Do you need it in some African countries or some Latin American countries or some of the Middle Eastern countries? Sure. You could definitely use it in those countries to protect yourself against devaluation and theft and misuse and stuff like that. So there is a need for it. And the problem with Americans is they keep thinking, why would I leave my JP Morgan account? Because you don't have to, but there's 2 billion people that don't have access to the same type of financial products that you do.
What coins are you holding in your personal portfolio? A little bit of everything?
Yeah, I mean, I have some Bitcoin, but more, more struggling along, hoping that the Ethereum, makes its comeback. I have a little bit of Solana in there as well too. So that's what I've been holding, and I've been holding on to them for many years, thinking that if they are going to become that disruptive financial force, that it's going to come from that, it's going to come from that kind of development and development and automation that it could definitely bring. And like I said, which one is closer to being the stable coin that you could use and the like? It's probably going to be on the Ethereum network.
I've got a personal question to close up with. You're a rock star on X. You've got almost 500,000 followers. How many times a day do you check it and engage with others? Do you have a team, or do you actually continue to do it on your own?
Oh, I do it on my own, and you could tell from all the spelling mistakes and everything else and every one of my I do have a team that works with me, but I usually do it on my own, and I usually try to keep it focused on finance and markets and the economy. I have opinions on politics and sports and fashion and culture, but I don't try to traffic in those on it. So I try to keep it very steady, and I try to use it more from an educational standpoint. I try to use it to explain things to people. So yesterday I put out a tweet thread trying to explain when the Fed cuts rates, do not always assume that the 10-year yield goes down. We discussed this earlier. And I tried to, because I hear a lot of people say, well, the Fed cuts rates, then mortgage rates will go down and everybody can buy a house because it's going to get cheaper. Well, hold on a minute. It doesn't quite work that simple. There's other things that can get in the way. So I try to use it for a lot of that, and I try to use it for a lot of explanation. I've been at it since 2018. So, my follower base has definitely taken a while to get there, but I'm very happy that it has gotten there.
Jim, thank you for being generous with your time. This has been hugely helpful. And yes, hope to see you again very, very soon. Thanks again.
Thank you. Enjoyed it.
Thank you for listening to You're in Business. If you've enjoyed the conversation, like, share, and subscribe. See you next time.